Welcome to Jargon Busters. Today we're going to talk about a well-known jargon that you have heard or read in investment columns. It's called diversification. What is diversification? Diversification essentially means not putting all your eggs into one investment basket. If you put all your eggs into one investment basket and that basket breaks, all your eggs will be damaged. So the easiest way to avoid or reduce the risk of your eggs being damaged is to spread your eggs across different investment baskets. When you do an investment, you may be tempted to put all your investment into one company share because you're familiar with it or you like the company. As you know, share price go up and down. Therefore, the value of your investment just go up and down with the price of the shares. And sometimes that degree of fluctuation can be quite large. To help reduce or dampen that degree of fluctuation in your investments, you could spread your investments to different company shares, different sectors, different industries. Why? Although all share prices go up and down, the degree they fluctuate are different between different company shares. And often, one company share can go up whilst the other go down. If you mix and spread your company shares in your investment that way, the degree of fluctuation of your investment will reduce. That's why the investment professionals often advise investors to diversify, because that reduces the risk or the fluctuation of your investments. Now I use company shares as an example, but when you diversify your investments, you should consider different types of financial assets as well. Shares is just one of them. You could also include investment in your investments, bonds or fixed income instruments like gilts, corporate bonds, etc. Many investors also include properties in their investment as a diversification. In addition, you should also consider diversifying into different style or types of investment. What do I mean here? Different types of investments mean different ways to generate investment returns. Many investors like actively managed funds. Actively managed funds generate returns due to the skills of the active fund managers. But now you can also generate returns using different types of investments. Many investors have started using passive funds. Passive funds track indices. They do not rely on the active fund manager skills, just rely on the market return, and they're cheaper than active funds. In addition, there's another type of investment called structured investment. Structured investment often have strategies that can generate returns that is not achievable by any active funds or passive funds. An example is structured investments with defensive features. These are structured investments that can generate returns even if the markets go down. So you could diversify your investment into different sectors, different industries, different companies. You should diversify investments into different types of financial assets, bonds, shares, properties, and you should also consider diversifying your investment into different style, different ways to generate investment returns, not just relying on active fund management. Thank you.